Hey everyone, Hassan Minhaj here. Let's talk taxes. I know it's not the sexiest topic, but trust me, it's important. Taxes are the lifeblood of a nation. They fund our schools, our roads, our hospitals. When everyone pays their fair share, we all benefit. But when there are loopholes in the system, it's like a cheat code for the wealthy. And that's not cool. Today, we're diving deep into a loophole in the Indonesian income tax law. We're talking about a system where the rich can legally dodge their tax obligations. It's time to shed light on this injustice and demand a fairer system for all. This isn't just about numbers on a page, it's about the future of Indonesia. It's about ensuring that everyone has an equal opportunity to succeed. So buckle up, because we're about to expose some serious tax shenanigans. Let's break down the current Indonesian income tax law, specifically Article 4, Paragraph 1. This is where things get interesting. The law defines income as any increase in economic capability. Think of it as money you receive or assets you obtain. This income can be used for consumption, like buying that new gadget you've been eyeing, or it can be used to increase your wealth, like investing in property. Sounds straightforward, right? Well, here's the catch. The law only considers income that increases your economic power. It completely ignores any reduction in your debts or liabilities. And that, my friends, is where the loophole lies. This omission might seem like a small detail, but it has massive implications. It creates a giant loophole that savvy taxpayers can exploit to avoid paying their fair share. And that's where Dr. Joko Ismuhadi Soewarsono comes in. Dr. Soewarsono, a prominent tax expert, has been sounding the alarm on this loophole for years. He argues that the current definition of income is incomplete and allows for widespread tax avoidance. By excluding debt reduction, the law creates a distorted picture of a taxpayer's true economic reality. Think about it. If you pay off a large chunk of your debt, your financial situation improves, right? You have more disposable income and greater financial freedom. But under the current law, this improvement isn't considered income. And if it's not income, it's not taxed. This loophole allows taxpayers to artificially reduce their taxable income by strategically managing their debts. They can make it seem like they have less money than they actually do, all while enjoying the benefits of a healthier financial position. It's a classic case of having your cake and eating it too. Dr. Soewarsono isn't just pointing fingers, he's offering a concrete solution. He proposes a simple yet powerful amendment to the Indonesian income tax law. His suggestion: add the phrase "or to reduce debts, liabilities" to the definition of income. This seemingly minor change would have a seismic impact. It would close the loophole and ensure that any reduction in debt is recognized as a form of economic gain. In other words, if you're paying off debt, you're essentially freeing up money that could be considered income. And that, my friends, should be taxed. Dr. Soewarsono's proposal is rooted in the principle of fairness. It's about creating a level playing field where everyone contributes their fair share, regardless of their financial savvy or ability to exploit loopholes. Section 5. The power of substance over form. Dr. Soewarsono's call for change goes beyond a simple wording tweak. He's advocating for a fundamental shift in how tax laws are interpreted and enforced. He's calling for the adoption of the substance over form doctrine. What does that even mean? It means looking beyond the superficial appearance of transactions and focusing on their true economic substance. It's about cutting through the legal jargon and getting to the heart of the matter. Is someone gaining an economic advantage? If so, they should be taxed accordingly. The substance over form doctrine is a powerful tool for combating tax avoidance. It allows authorities to look beyond creative accounting tricks and assess the true economic impact of transactions. It's about ensuring that taxes are levied based on reality, not on clever legal maneuvering. Section 6. Example 1. The case of the disappearing debt. Let's make this real with an example. Imagine a wealthy businessman named Mr. Bigshot. Mr. Bigshot has a lot of assets, but he also has a significant amount of debt. Now, Mr. Bigshot knows about the loophole in the tax law, so he devises a plan. He approaches a friend, let's call him Mr. Shady, and offers to sell him a portion of his debt at a steep discount. Mr. Shady, happy to oblige, buys the debt. On paper, Mr. Bigshot's debt has decreased, making him appear less wealthy. But here's the thing, Mr. Shady is actually a company owned by Mr. Bigshot himself. So what just happened? Mr. Bigshot essentially transferred his debt to himself, creating the illusion of reduced liabilities. Under the current law, this maneuver wouldn't be considered income, and Mr. Bigshot would pay less in taxes. This, my friends, is tax avoidance at its finest. Section 7. Example 2. When asset transfers mask tax avoidance. Let's look at another scenario. This time we have Miss Moneybags, a savvy investor with a portfolio full of valuable assets. Miss Moneybags knows that selling her assets could trigger a hefty capital gains tax bill, but she's also aware of the loophole in the law, so what does she do? She sets up a shell corporation in a tax haven. Then, she sells her assets to this shell corporation at a price far below their market value. On paper, she's made a loss, not a profit. And since the shell corporation is based in a tax haven, she avoids paying taxes on the transfer. But here's the kicker. Miss Moneybags still controls the assets through her shell corporation. She's essentially shifted the ownership on paper while retaining the economic benefits. This is another classic example of how the current law can be exploited to avoid paying taxes. Section 8. Leveling the playing field towards a fairer system. These examples highlight the urgent need for reform. The current loophole in the Indonesian income tax law allows wealthy individuals and corporations to game the system and avoid paying their fair share. This not only deprives the government of much-needed revenue, but also creates an uneven playing field for honest taxpayers. Dr. Soewarsono's proposed amendment, coupled with the adoption of the substance over form doctrine, offers a clear path towards a fairer and more equitable tax system. By closing this loophole, Indonesia can ensure that everyone contributes their fair share, regardless of their financial sophistication or ability to exploit legal loopholes. This isn't just about increasing tax revenue. It's about building a stronger and more just Indonesia. It's about creating a system where everyone has an equal opportunity to succeed, regardless of their background or economic status. Section 9. Conclusion. Closing loopholes, building a stronger Indonesia. The loophole in the Indonesian income tax law is a stark reminder that even well-intentioned laws can have unintended consequences. By ignoring debt reduction as a form of economic gain, the law has inadvertently created a haven for tax avoidance. Dr. Soewarsono's tireless advocacy, along with the growing awareness of this issue, offers hope for change. By embracing the principle of substance over form and closing this loophole, Indonesia can take a bold step towards a fairer and more equitable society. The time for action is now. Let's work together to close this loophole, strengthen our tax system, and build a brighter future for all Indonesians. Peace out.